Hello, welcome, everyone, to Market Madness. Today, we're diving deep into market stock risk, capital market line, and, yes, the infamous CAPM. Ready to have your minds blown?
Ready as I'll ever be. But what's this about a new definition of stock risk? Last time, I thought stock risk was just when my coffee spills on my stock market app.
Oh, Alex, if only. No, we're talking about stock risk in relation to the market. Picture this. Risk isn't just about how much your stock can bounce around on its own. It's about how much it bounces around compared to the entire market. Also recall from modern portfolio theory that when we do diversify, portfolio risk is reduced up to a certain level. The remaining risk that we cannot avoid is what we call the market risk. Imagine your stock is a rebellious teenager. Its risk is like how much it misbehaves relative to its entire high school.
Got it. So, if my stock is always causing trouble, it's risky compared to the market?
Exactly. And the more it misbehaves compared to the market, the higher its risk that we measure with its beta. Beta measures how much your stock's risk is correlated with the market's risk. High beta means more drama, low beta means your stock is more chill. Now, let's talk about the efficient frontier, something similar to the one seen in modern portfolio lecture. But wait, today, we have a new and improved efficient frontier. Picture it as a roller coaster of returns. We're talking new thrills and chills, including our sparkling new capital market line, or CML.
A roller coaster? Sounds like my stock portfolio.
Remember from our last lecture on portfolio theory, we have the traditional Markowitz efficient frontier, which is a concave curve with the optimal portfolios. If we combine, now, the risk-free rate, like Treasury bill yield, and the market portfolio, which is optimal also, you can take an ETF for the market index, for example. Then you will end up with more interesting portfolios in terms of return and risk. All these new portfolios lay on the CML straight line.
Got it. Very simple.
Precisely. The CML shows the best returns you can get for any given level of risk, combining the market's optimal risky portfolio with a risk-free rate. It's like choosing between a safe ride on the Ferris wheel or the wild loop-de-loop of the CML.
But how we can use this in practice?
Let me finish mixing these ingredients, please.
Okay.
And here we have our complete optimal portfolio recipe. It's a mix of our optimal risky portfolio and the risk-free asset, just like how you'd mix flour and sugar. It's just a combination of the risk-free rate, bond or treasury yield, for example, and the portfolio that maximizes the Sharpe ratio as the optimal risky portfolio. This known as two-fund separation theorem proposed by Tobin.
So, the optimal risky portfolio is like the chocolate chips, and the risk-free asset is like the flour?
Exactly. By adjusting the amount of each, you get the perfect cookie, or in finance terms, the perfect portfolio. Riskier portfolio for more excitement, more risk-free asset for safety. But you should pick up the one that is consistent with your risk aversion.
Got it. Very simple.
Have you never seen these guys in person?
No.
Neither have I, but let's see what they did. Welcome to the CAPM theater, where these guys developed the capital asset pricing model. Imagine CAPM as a dramatic play about risk and return. The plot. How much return you should expect based on your risk compared to the market.
So, CAPM tells us how much reward we should get for taking on risk.
Yes. And it all hinges on the market risk premium and beta. The market risk premium is the extra return you get for taking on market risk, and beta measures how risky your stock is compared to the market.
But how we can use this CAPM in practice?
Behold, the security market line, or SML, is just the visualization of the CAPM idea. It's like the stock market scoreboard. It tells you the expected return of any stock based on its beta.
So, if a stock's return is above the SML, it's a good deal.
Exactly. If a stock is below the SML, it's like finding out your favorite ice cream shop is out of your favorite flavor. It's a bit of a letdown.
Got it. So, if the SML says my stock should give me more return for its risk, I'm in business.
Absolutely. And that's how you can use CAPM to strategize your investments. If you stick to the SML, you'll have your portfolio in top shape.
Thanks, Professor. I feel like I've just graduated from Finance 101. The fun way.
And that's a wrap for today's Market Madness. Remember, in finance, the only thing that should be risky is your weekend plans, not your portfolio. See you next session and goodbye.